A different sector could drive the next leg of the rally. That's according to our next guest, Chris Verrone, head of technical and macro research at Strategas, joins me now, Post 9. Welcome back.
Great to be here.
All right, we'll get to that in a second,
Yeah.
show some charts that help tell that story. But broadly speaking, how do you feel about this rally right here?
I think what's most important about this move is that there's still a cyclical tone to the leadership. We see it with discretionary over staples. We see nothing from utilities. I think that's an important point. If this market's really going to change character, I would expect to see the defensives group start to show up, and there's been no evidence of that here. Also, none globally as well. And look at the leadership from the autos and the leaders in Europe and Asia and Japan. So very cyclical, pro-cyclical tone still persists.
I mean, yields may be a little too elevated still to get money into the areas you're talking about, correct? Utilities, staples.
You know what's unique when you look at this historically? I know what you're saying intuitively makes some sense, but when you look at it historically, typically the defensives will actually start to work in the last move of a rate move higher. The market begins to anticipate. The market begins to sniff out that, hey, wait a second, yields are too high, this is going to be a problem. I think the big level on yields here is 450. If the market's really going to say, wait a second, I think it happens above 450 10-year yields.
Well, maybe that trade was ready to happen until, Powell said at the last news conference, okay, March, not really going to happen, folks. And then now it's being, pushed even further out.
And Scott, I think the best clues on rates themselves are from the fabric of equity leadership. And when I look at some of the real speculative stuff that's still working, if the market was worried about yields running away here, I don't think small cap biotech would be leading or IPOs would be leading. So I think there's a tone here that generally says don't worry too much about bond yields running away from us.
You are looking specifically, as I mentioned at the top, at a couple of sectors. One where you see sort of about to broaden out, money continue to go in, and the other maybe not so much. You have a couple of charts to back it up. Talk to us.
Yeah, I think on the maybe acting better than advertised is healthcare here. And frankly, it's been a bad sector for 3 years. What I like over the last 4 or 5 months as we've been talking about this is it's finally broadening out. You have about 80% of healthcare above the 200-day moving average. It's the best we've seen in 3 years. I thought importantly last week, you had more healthcare stocks make a 52-week high than at any point we've seen really since the heyday of 2020, 2021. So there's a broadening out here. That's rarely a bad thing. I'm not sure all of these are the most timely, just given how extended this move has come in the short term. But in terms of looking for longer term performance, I think the setup in healthcare is pretty compelling here.
Looking at it now, it's up, 5.5% or so over the last month. It's not like technology is not a huge slouch. It's up about 3 2/3%. I find it hard to believe that money's not going to continue to follow the money into technology.
You know what's a little unique about tech, though? Almost the opposite of what we've seen in healthcare. As tech has gone on and made new highs the last couple of weeks, the percent of stocks making a new high in the index has actually been quietly contracting. Now, that's not fatal. That's not a death sentence. But it is maybe a little sign of exhaustion. And when you look at the ETF flows in particular, there's been a surge, as you know, of money into tech. On the other hand, there's been a dearth of money into healthcare. So I like this almost contrarian setup where what would be a logical place if money leaves tech, what would be a logical growth corner of the market for it to go to? I think circle healthcare in that sense.
Let's say the broadening doesn't happen in any more meaningful way, despite what the charts may be trying to position us to think now. What does that mean for the rally itself? Do you grow less confident about it if that happens?
Yeah, I might push back on the premise a little bit because the market's fairly broad. I mean, 75% of the S&P itself is above the 200-day moving average. That's hardly narrow. I also think
that's fair.
When we look at the equal weight S&P, right? The equal weight S&P is always the benchmark people use to gauge whether a move is broad or a move is narrow. Equal weight S&P price-wise is making 2.5-year highs here. So those stocks might not be leading. They might not be doing better than Microsoft or better than NVIDIA. But to say that the move is narrow, I think is a little misleading.
Okay, no, that's fair. As we discussed at the outset in some respects, too, the idea that the Russell is the place to look maybe is misleading or a misnomer. But how would you view small caps as their relevance and importance to the overall story?
Well, I think they're important from a couple of perspectives. Number one, we know what the biggest weights are. Banks and biotech. One of those groups is really in gear right here. You look at the small cap biotechs, they're breaking out across the board. And I go back to kind of what we said at the top. If bond yields were really going to run away, I'm not sure small cap biotech would be behaving so persistently. We went back and looked at all the groups that have the highest sensitivity to bond yields. Small cap biotech comes up at the top of that list. So if yields were going to run from us here, I don't think we'd see that. Secondly, when you look at groups like industrials within small caps, I mean, this has been persistent leadership for 2 years. Industrials broadly have been persistent leadership for 2 years. So I recognize the largest weight, the financials in Russell 2, isn't as probably robust as we'd like, but industrials and biotech pretty good.